If you were shocked by the IPO pricing for DoorDash and Airbnb last week as I was, well, guess what? We are not alone. Hey everyone, this is Kevin, the Apptrepreneur, and today we are talking about Jim Cramer and DoorDash and Airbnb stock. Now, we talked about the IPOs quite extensively last week, or was it 2 weeks ago? It's, boy, the holidays, 2020, But the thing is, on here, and this again, this is not financial advice. I tell you what I am going to do. I'm not telling you what you should do. Always talk to a investor. For the record, I decided to buy Airbnb stock. I did not decide to buy DoorDash stock because I think long-term Airbnb will be a much better investment. That said, the fact that both of them opened well above 100% of what they were initially asking for was definitely difficult. I wanted to buy 14 shares of Airbnb when it debuted, or when it was going to debut, at a $65 price point. It opened at $142. I had to scale that down to $8. And that did not make me happy one bit. Well, apparently I'm not the only one who was upset by that pricing. Jim Cramer, who I believe he does that show Money Talk, and he's pretty good in a lot of his predictions. He's not 100% solid. Again, you want to talk to a personal financial advisor before you make any financial decisions, but he talks stocks, he talks the industry, and he has now been very critical of the pricing. You would think that a lot of people would say, oh, that's great, you opened like double what you were asking for. And Jim Cramer's like, no, that's not good. In fact, because Airbnb and DoorDash opened at well over 100% of what they were asking, he calls the IPO pricing broken and embarrassing. Now, here's why. So, CNBC's Jim Cramer on Friday sharply criticized how investment bankers handled the recent initial public offerings for companies such as DoorDash and Airbnb, two tech companies that saw major pops in their stocks after they began trading this week. And he's quoted saying, "I don't want to say the market is broken." Get out of here. Email. "But the process of how we're doing these deals is definitely broken," he said on Squawk Box. So he wasn't on, I think that was a podcast of some sort. Food delivery app DoorDash closed higher by more than 85% in its market debut Wednesday, while home rental company Airbnb ended its first day of trading on Thursday up more than 112%. And again, this sounds like this would be a good thing because you buy stocks as you want it to go, right? Like, doesn't that suggest future growth? But no, Cramer has some things you might be thinking about. Those massive first-day moves, which left so much money on the table, are not the fault of the companies, Cramer said. Instead, he said it was embarrassing work being done by the financial firms that work on the IPOs. They ought to start focusing on how to do it better. While big market debuts are great for shareholders, especially ones who invested on the ground up, they're not so great for the companies. Case in point, Airbnb, which could have raised over double the money on its IPO, priced shares at $68 for a $3.5 billion haul. For DoorDash, pricing its IPO at $102 per share, raised $3.37 billion. Had the company priced the shares where they close on their first day, that could have raised more than $6 billion. And the reason for this is because at a lower cost, people might be willing to buy more shares. Now, here's basically what happened. And I'm going to explain it as best as I can. Keep in mind, I'm not a financial expert. So if there are financial experts in there, and I happen to get this wrong, feel free to comment below what I got wrong, and I'll pin your comments so that people can see what I got wrong. But from what I understand, these were the initial prices, $68 and $102, that they were supposed to debut at. And they were projected to raise a certain amount of money for those prices. Now, as leading up to it came up and they saw the pre-orders and all this jazz, they started realizing that, throughout the day they could go to those prices. So rather than open at the $68, the $102, they raised the price of those shares because that's what the tracking was telling them they were going to wind up at. But here's the problem. Once the higher price shares go up, then people who are going to buy the shares at the lower price are now looking at double or more of their money, and they have to stop and think twice. Again, case in point, I sold some of my stocks for the money for Airbnb. I decided I was going to buy 14 shares. 14 shares. at a cost of $75. I put it in the Robinhood app to pre-order at that price. And hey, if it came in lower, I might even buy 2 more if it came in lower, like than what I was setting to buy. But that order did not go through because it opened at $141. So I had to cancel that order, and I still bought it, but now I bought 8 shares. And some people either bought less shares of the stock as a result, or they decided not to buy any at all because at that point it was too expensive. My mom, who's, me and her have kind of become stock twits, if you will. I think that's the term for stock buddies now. We kind of talk to each other almost every day about how our stocks are doing. She was going to buy Airbnb. She was one that goes high as $80 a share. It opened at $144. She didn't buy any at all. And that's the kind of money that investors lose out on when they price too high. Now, Cramer said the recent price action reminds him of the dot-com boom in 1999, where there was similar levels of interest from retail investors in soon-to-be public companies. And he said this is what happened in 1999, where the syndicate desk completely misjudged the public, and the public is back, and they're pricing as if the public isn't back, and it's just the same old funds buying stock, the Mad Money host said. This new cohort, and it's not just Robinhood, but it's the public, has not been factored in, so everybody keeps blowing it. Cramer referring to stock trading app that's favored by younger investors. And by the way, Cramer and other investors are very critical of trading apps like Robinhood, which, if you don't have it, you can get a free stock by using the referral link below. Just have to put that out there. And they're critical for a reason. Young people are not using Robinhood like investors. They're using it like day traders, and day traders can lose a lot of money. Anyway, on Wednesday, before DoorDash started to trade, Cramer said he believed there was rabid money chasing technology companies, particularly from the younger investors who frequently use their services. I agree with that. I mean, I have a friend who will remain nameless just in case she's watching this, who she was considering investing in DoorDash, and I strongly encouraged her not to do that, and I said DoorDash is a stock that's headed for disappointment, especially at this price. And she said, well, of course, the first thing I said was it doesn't make money. And she said, well, Amazon didn't make money for years. And it's like, no, you don't understand. It's not making money at the best of times. And there's other food delivery apps. Like, look, you can love DoorDash. I don't know why. You can love DoorDash if you want. But what does DoorDash do that Grubhub, Postmates, and Uber Eats and Caviar don't do? Heck, Caviar's got the biggest selling point. They're luxury dining. You're not going to see McDonald's on Caviar. So the only okay, granted, Caviar is owned by DoorDash, but so there's many places that can do what DoorDash does, and then you have Pizza Hut and Domino's and Taco Bell and Burger King. They're starting to set up their own delivery services, and they're not going to want to partner with a middleman at some point. So DoorDash is just a long-term bad investment, but she uses the product and she's on Robinhood, so she's considering investing in DoorDash. And these are the kind of things that make people like Cramer just go. So anyway, let's finish this out. So Cramer says, I think there's money that basically says we don't really care what that opening price is going to be. There's not going to be a lot of discipline in a lot of these market buyers. They're not going to put a price limit on it. There was, in fact, notable millennial interest in DoorDash and Airbnb on their first days of trading, according to TD Amstrade's chief strategist, JJ Kinahan. In a Squawk Box interview Friday, Kinahan said about 41% of DoorDash's trades on his brokerage platform were from millennial clients, while Airbnb was about 45%. Now, how has DoorDash done since going public? Well, here's the thing. They started at $189.51. This is the month. And they've gone down. Although they have picked up a little today. They're up a little today to 161.92. But here's the thing: if you bought on day one, you basically more or less lost $30 a share. Now, for some context of that, let's open the calculator app. If you bought 10 shares, 10 shares, and you multiplied that by, let's get close, let's say 28.56. You have just lost $285.60 on paper. Now, of course, this could go back up, but let's say it goes down to $100 in a month. Let's say you bought 10 shares and it goes down, you lose $89.20 per share because it's now $100 or whatever it was. You've lost $892. This is not. Now, what about Airbnb? Well, Airbnb, I should have brought that up earlier, but let's go to the month. They've done a lot better. Now, I did buy at this price, and I didn't take my own advice. I should have, about waiting a year before buying IPOs, but I didn't. I kind of got sucked up into the trade, and as a result, it went down. Had I bought it a few days ago, it would have been $124.80. Heck, I probably could have bought a whole 10 shares at that point. But look, it's already going back up. Now, Airbnb, again, I believe is in a much better position to go places because they are going IPO at the worst time. This is their darkest moment. They're not making any money. They're really not getting a lot of business, but the travel industry is hungry for a major rebound, and that's where they will probably do well next year. And I wanted to get on the ground floor because this one, I felt if I waited a year, it might be too late. That's my personal opinion. Again, talk to your financial advisor before making any decisions. But I agree with Cramer. I would have bought a lot more stock. It'd have been a lot cheaper, and heck, who knows? It might have actually gone up to 150. If the market could see that Airbnb was skyrocketing on day one naturally, then that means more investors might have come in. And same thing with DoorDash. So I think the IPO pricing is broken. It's, they're charging for these companies if they've actually proven themselves first, and they really haven't. And that can be a big problem if you're an investor. But anyway, I would like to know what you think about all of this. Do you think Cramer has a point? Did you buy any stocks in either of these companies? How are you feeling about that investment right now? I would love to know. Comment below, like, favorite, share, subscribe, and as always, flame responsibly. Merry Christmas.